Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, Francis Donald, Chief Economist, RBC, the Royal Bank of Canada, and just outstanding work on the equation that is gross domestic product. I'm fascinated by the Coca-Cola earnings, where they basically had no unit growth, and it seemed like good organic revenue growth was all pricing power. Is pricing power going to evaporate as nominal GDP evaporates?
Pricing power is already becoming more difficult, and that's because the general state of the consumer is becoming more difficult, and most importantly, the general state of the low and middle income consumers is becoming more difficult. Very little excess savings left, much less real wage growth, especially because that group is spending more on the higher inflation areas like food and energy, and those low and middle income households just haven't had that boom coming from stock market gains. They have less than 5% of their portfolio there. So back 2 years ago, you could have pricing power because there was money to go through. That money is evaporating, and the spread between the haves and the have-nots is becoming much larger. Depending on what you sell and to who, that's either good news or bad news.
Well, the federal government seems to be responding. They're cutting interest rates from a fiscal perspective. Lots of spending plans out there from the government. Is that enough to sustain, to lift this economy, including, I know you're bringing back the K-shaped economy discussion for the folks that have not been participating? Is that enough to help those folks, do you think? Well,
it depends where it goes. And I can't believe we don't talk every single day about federal spending. It has been so extraordinarily disruptive to every single economic model that exists, and it has changed the way that we have to evaluate the cycle. But problematically, we see these deficits rise and spending increase, but net interest spending is now larger than defense spending. And if we're spending government money and it's going to pay treasury holders outside of the United States, that's not helping everyday Americans. It's not boosting growth, and it's not actually inflationary either. So it isn't just about the amount of government spending, which is just chaotic in terms of how it's changing the way the economy operates. It's where it's going. And defense, net interest spending, even entitlements is not going to be the juice that fuels this extended, continuous, resilient aggregate economy.
I agree with the concern about the federal debts and deficits and all that, but a lot of folks will come back to me and say, hey, interest rates are still relatively low. People are buying our debt like crazy. Don't worry about it.
Well, I don't worry about it so much from the, there's going to be a bond market collapse moment. I mean, the risk of that just empirically has to be higher now than it was when we didn't have near record levels of debt to GDP. What concerns me is that at a certain point, we're going to hit up against limits. And if the main support, the main pillar that is driving the so-called soft landing is government spending, sometime in the next 4 years, we're going to have to take a step back. And if the Fed is not focusing on this and the fact that they actually probably can't keep rates super high, it will lower future government spending, then I would be really surprised.
But are they too data dependent? You and I shared a stage in, I think it was Toronto, I can't remember. But, the bottom line, Francis Donald, is we're addicted to the parlor game. We're addicted to data dependency. And all I can say, Paul, that hasn't worked out.
No, it hasn't
What's
worked out.
What's a new approach?
We cannot be month-to-month data dependent. And I know the market runs off of this, but there's a couple reasons why. First, we have huge election uncertainty. It has paused business decision. We see this in surveys, small business surveys, ISM manufacturing. Companies are saying we're just holding off. So that's a pause. We have really low response rates on a range of our economic data. And then related, we have sizable revisions. So we're seeing these sizable market moves, perhaps even policy decisions that are coming off of month-to-month movement. We are in the dark, or at least the moment of the day where the dusk comes in. We cannot see fully.
Listen to her.
So the the Federal Reserve is going to have to focus on that 6 to 12 month view. And what they're likely seeing is the unemployment rate has been creeping higher since January of 2023. Inflation looks relatively contained. Inflation expectations are all right. Low income, medium income consumers expressing concern about the labor market. They have to calibrate policy back to that more neutral level. And I hope they're not looking at month to month data and that they're looking more at 3 to 6 month trends. If they are, it's a continued easing cycle, at least down to 4%, maybe beyond that towards 3%.
What's your view of the U.S. economy here? Is it resilient, or do we really still have to think about a recession?
Can I be bold and ask which U.S. economy? Because I'm having trouble just thinking about one U.S. economy right now. If I aggregate all of the parts, real difficult to get 2 quarters of negative GDP, in part because of how much government spending is coming through. So I can't be in the recession camp because that's not formally a recession. But if I look at manufacturing has been contracting in the U.S. since 2018. Industrial production is smaller. Existing home sales are 30% below where they were before COVID. They're at the level they were in the Great Financial Crisis. Small businesses who employ 80% of the population are the most negative they've been since the Great Financial Crisis. So on aggregate, things look good, supported by a really strong high income and CEOs, but the rest of the economy is dicier.
Francis, we don't care. All we care is that the Rangers scored with 54 seconds and that Brzezinski scored at 2:05. They clocked years in my Montreal Canadiens 7-2. It's another difficult year, isn't it? It's a rebuilding year.
A rebuilding year is a good way to think about it. I would agree with you, Tom.
You should see the RBC tickets at the Forum.
Oh, fantastic.
That's why she went to RBC.
Yeah,
I couldn't possibly comment.
Francis, thank you so much. With RBC, I can't say enough about her research. Get that from the Royal Bank of Canada, RBC, at Capital Markets. We protect the copyright of all of our guests.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
David Kelly joins, Chief Global Strategist at JP Morgan Asset Management with decades of experience. David, 18 months ago, you established a responsible vector that we would see non-farm payrolls come down, various employment statistics, and the emotion of maybe a negative non-farm payrolls. We didn't get there, but can we revisit this and say we're in the process of worser labor statistics?
Well, the problem, Tom, is you've got a very good memory for bad forecasts. There was always a risk that we would see a negative employment number because really we've seen a great deal of volatility in payrolls. And so 18 months ago, we did see some weakness. We still never thought, we didn't quite call for a recession last year. We're still not calling for a recession right now. And we could, the payroll report we get at the end of next week, that's going to be volatile because of weather issues also. But to me, the most important thing is that next week we're going to publish a GDP number of about 3% or maybe more than 3% in annualized growth in the third quarter, following a quarter of 3% growth annualized in the second quarter. And that tells me the economy's got plenty of momentum. And so on average, it should still generate positive payroll growth. So I'm a little bit more optimistic than that old headline would suggest.
This is what I love about the show, Paul. The Class X, they come out. It's a tough business. You got to make a call. And David made a call. And as far as I'm concerned, out the x-axis, he's going to be right at some point. But this 3% GDP, no one saw this coming.
No one saw this coming. So, David, let's think about this. I mean, when JP Morgan Asset Management, nobody more global than you guys.
Yep.
Where do you see kind of the best opportunities here? When you sit down with your clients and you sit down with your portfolio managers, where are you seeing the best opportunities globally here?
Well, I think this is a time when people all need to think about protection of the downside, and it's not because of any concern about the economy, global economy, or the U.S. economy. I mean, the global economy is mixed. The U.S. economy is doing pretty well, but valuations are very high. So, I think the opportunity is in diversifying into areas that are not overly expensive right now. But really, that is more. It's not so much about finding another way to goose up returns, which honestly have been great. It's really a way of protecting portfolios at this stage by making sure you're not too concentrated after such an extraordinary bull market over the last 2 years.
what do we need out there to sustain this bull market? I've got a Federal Reserve that is cutting rates. I'm not sure to what degree or how quickly. I think I've got a pretty decent earnings outlook here, at least here in the U.S. Is that enough to continue to push risk assets higher?
Not quite. I think we need a relatively benign outcome from the election because there is a danger. Obviously, there's greater potential for a Republican sweep than a Democratic sweep, but a sweep on either side would mean more aggressive fiscal policy, which could push up long-term interest rates. And we're already seeing that to some extent as former President Trump's polling numbers have improved slightly. We've seen long-term rates go up because there's the thought that if you have a Republican sweep, you're going to have a much more aggressive fiscal policy along with the trade war. Which could push up higher, could cause higher inflation. So I think there is a danger of a policy mistake, not so much from the Federal Reserve, but from the federal government here. And that, I think, is a risk investors need to think about.
Why did we all get 3% GDP wrong? What if Y equals C plus I plus G plus net exports? What got us from 2.x out to a legitimate 6 months of 3% growth?
There are two things going on here. The most important is consumer spending. Consumer spending, 68% of demand. We think that it's going to go up by more than 3% in the third quarter, maybe 3.5%. Wow. And what's going on is two things. One, the wealthy are doing extremely well here. We've seen a $50.1 trillion increase in net worth in the last 5 years. Just explosive gains in wealth, both in terms of housing wealth and stock market wealth. And that is fueling the spending of upper income consumers. And second, we've actually seen some better real income gains for our lower and middle income households. We've seen just in the last month, we've seen average hourly earnings growth exceed CPI growth for the 17th straight month. So even though the public mood is pretty grumpy, actually lower middle income households are also seeing gains, and that's showing up in higher food spending and higher clothing spending in the retail sales report. So overall, the consumer still has got some fuel here, and that's the biggest thing. And then the other thing is there's just a lot of corporate spending on AI, which I think is helping investment spending overall.
So when you read Michael Feroli, which I know is torture, but when you read J.P. Morgan Economics, are they telling you it's a productivity overlay? I read it very closely, but there's some productivity gains also going on. I don't think the productivity gains are really AI driven here, but if you look at the GDP numbers, productivity gains since the start of this decade have actually been better than last decade. So that's going well too. So, in the big aggregate numbers, the US economy is doing fine. 4.1 on the unemployment rate, 2.4 on CPI. That sums to 6.5, which they used to call the misery index, the sum of unemployment and inflation. But that's better than it's been 87% of the time over the last 50 years. So the economy is doing fine. I just worry that individual investors may be sort of caught offside here if they're overweight the overpriced within these markets. Sorry, Paul.
No, I was just going to say, that's exactly how I feel. It seems like things are generally pretty decent out there, but that's probably, Tom, to a reasonable level reflected in the markets.
And it folds right into the election.
Yeah.
Of an election of politics of haves and have-nots. Look to Kayleigh Lyons and Joe Matthew for their coverage of that, heating up here in 3 hours. David Kelly, thank you so much with J.P. Morgan. Can't say enough about the bodywork.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let us dig into the tariff debate. Ernie Tedeschi, first of all, Ernie came out of the Stanford Combine. He's, of course, been at the White House CEA, and he's written an incredibly historic treatment on tariffs. Ernie, first of all, did you study with John Taylor? Like, when you went into Stanford, did you have to sit there in a lecture hall with John Taylor dressed up like a raisin?
I missed out. I demanded my tuition back. I was there when John Taylor was on sabbatical.
There you go.
My My Econ 1 was taught by somebody else, unfortunately.
When you look at the foundations of economics, you look at history, and you have nailed it with your Bloomberg Opinion piece. Right now, the average tariff is 2.5%. I would think most Americans think it's higher. We could go back to World War II, 1899, or dare I say, to the shocking tariffs of about 1820. What are Harris and Trump going to do?
So I think Harris is going to basically keep business as usual right now, very much like Biden has done. Biden kept the Trump tariffs, increased a few of them, but basically rearranged some of the tariffs mainly on national security grounds. What Trump has done or has proposed, and what we looked at in our Budget Lab report, that was the basis of my Bloomberg Opinion column, is he's proposed a bunch of different expansion ideas for tariffs, and they've been all over the place. And so what we did in our report was we listened to his remarks over the course of the campaign, and we tried to piece together 12 different scenarios that captured the spirit of what President Trump has talked about. And we created a range of different proposals. On the low end, 10% on all countries, 60% on China, but exempting all countries with which the United States currently has a free trade agreement. And on the high end, 20% on all countries, 60% on China, and 200% on Mexico. So that gave us a bookend of ranges for different ideas.
So, Ernie, what do the textbooks tell us that tariffs are designed to do? And then the question is, do they work?
Yeah. So the textbook tells us that tariffs are designed to protect domestic industry from outside influence and to let domestic industry grow. I think that there has been this sort of historic argument that tariffs were good when America was young, like in the 1800s. And that was sort of accepted wisdom. I will say that over the last 20 years, there's been more and more challenges to that accepted wisdom. You've seen more and more historic American economic research that says that America grew in the 1800s despite our really high tariffs. Tariffs in the 1800s were upwards of 40 or 50% in average effective rates back then. But that was sort of the rationale. But then the textbook tells you that as your country matures, as its domestic industry becomes more competitive with global markets, the advantages of having having inputs and capital and labor compete on an even playing field in a global market outweigh the protectionism of throwing up protectionist tariffs on your border. What we have, the evidence of what we have seen is that, tariffs nowadays, don't work as advertised in terms of creating jobs. And that doesn't mean that if you throw up a tariff, we're not saying that in no cases, no jobs are created. What we're saying is that net, the bad outweigh the good. Exactly that the cost to factories of increased parts coming in, for laying off workers outweighs any factory that creates a job.
Okay, Ernie, because of time, I want to cut to the chase here. President Trump, in his conversation with John Micklethwait of Bloomberg News, was adamant that he's talking about a magnitude of tariffs that will create a jump condition of labor formation in America. I don't want to go politics on this. I want to go, is there any history taught at Stanford or Berkeley is Barry Eichengreen or Brad DeLong going to tell me that if I get a magnitude tariff leap, I will create American jobs? Is there any evidence?
No. What we found in this report is the magnitude of tariffs that President Trump has proposed means, number one, higher prices, on the order of 1.5% to 5% for consumers. So that's $2,000 to $7,600 for consumers. So that creates hard choices for consumers. They're going to have to substitute to cheaper
but will it
goods
create? Is there any evidence is there any evidence that it will create jobs in America? My problem, and I'm thinking of William Klein at the Peterson Institute, is definitive on this. Paul, it's real simple. They're going to raise tariffs to go after Mexico, so the jobs are going to move to Vietnam.
I know. I don't know how that plays out. I don't have,
no.
And Ernie, probably the other thing we hear probably most often, and I don't know if this is true, are tariffs a tax on the U.S. consumer?
That's right. No, there's probably nothing else more studied in trade literature than who bears the burden of tariffs. And it's very clear. It's the U.S. consumer and businesses that pay the tariffs in the end. So it's not the other country. U.S. consumers pay it at the end of the day. And so, that's what U.S. consumers need to weigh, when they hear this rhetoric about consumers, is that they're going to end up paying it at the end of the day. And it's net, it's not going to create jobs.
Okay, huge clarity. Ernie, thank you so much. Ernie Tedeschi.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
This is the most important interview of the day. Look in the mirror tomorrow morning and say, hey, where am I with my wealth creation? In the trenches. Alicia Manel, the giant at Boston College, announcing her retirement. We're efforting Dr. Manel to have her on. Just a huge victory lap for all of her retirement work. Pulling the short straw for Jane Fraser at Citigroup was Kristen Bitterly. They said, Kristen, go out there to professional organizations and help them try to get to retirement. Kristen Bitterly had a wealth at work at Citigroup. How bad is it? You walk into a fancy law firm, they're hiring Citigroup. What percentage of partners, associates, what percentage are behind the eight ball?
Well, I would say the good news is that we have been covering law firms for over 55 years. So we're celebrating our 55th anniversary just in a couple of weeks. And so we have long history working with over 900 firms, many of the AmLaw 200 firms. And so I think where we're involved, the strategy has always been we're following people through their career journey, starting from entry-level associates through to senior partners.
Yeah, but how many are behind right now? Alicia Manel would say, Roger Ferguson would say, we've completely screwed this up. How many fancy people at fancy law firms are behind the eight ball?
I'm going to offer another angle on this. I would say not behind, but I think what happens is we don't teach financial literacy in this country. So what we see very commonly, whether it's at law firms, whether it's at corporations, whether it's at professional services firms, you're someone who's been focused so much on your career, so much on your family, and then you basically find yourself in a situation where you have all of your savings in a savings account and you're underinvested. So the question there is, it's never too late to start, but the first thing you have to start with is making sure that, one, do I have the right estate plan in place? Only 1 out of 3 Americans have a will in place. And 2, do I have a financial plan? Only 1 out of 3 Americans have a financial plan in place. So when you combine that, Tom, with your question around, okay, retirement assets, you have around 67% of Americans with some type of retirement asset. However, only 30% feel prepared. So there's a big
70% of America, 70% of Sullivan and Cromwell. I'm just picking on them. I mean, Paul, it's amazing.
I know.
It's like the national topic.
It is a big topic. So where do you start? If you have your initial meeting with a client, where do you start?
So you have to meet them where they're at in their journey, first of all, and it's never too soon to start. So the reason why a lot of people fail to plan is they think they're not wealthy enough, they're too busy. We could come up with all of the various excuses. And so early on in your career, it's really creating that financial plan to say, when can I be prepared to buy a house? How am I thinking about taking on debt to do that? A lot of purchases, this is another kind of shocking stat, 70% of purchases are emotional. People will go in and buy a home.
Or a Vespa.
Or a Vespa. Yes, Tom, that too. I saw that photo. That was great. But I think when you have that plan and you kind of then say, okay, where should I be investing? How should I be maximizing certain accounts? How can I take advantage of actually the structuring and planning? So we talk about financial literacy within this country, but we've also added a lot of complexity in the sense that...
Come on. Okay, Orzag's over at Lazard now. When he was at Brookings, he said, look, we got to do an automatic buy-in on 401k. I mean, that's all there is to it. Are we getting anywhere nearer to where we approximate Paul Sweeney's ginormous multi-8-figure 401k?
I mean, look, I think one of the other data points that is important is I do think we're getting closer in the sense when you look at the boomer generation and you look at the anticipated wealth transfer that we're going to experience over the next 2 decades. It's anticipated it's going to be $90 trillion. Over the next 20 years. So there is massive wealth creation and generation for those who are homeowners, for those who have exposure to the stock market. Clearly, there's been benefits within that. But I think the key thing for our clients is the unifying factor is they are busy professionals who are trying to make it in their career and they're trying to take care of their families simultaneously. And sometimes what's best for you takes the backseat. So just taking that moment to come up with a plan and discipline, you will be way ahead of the game.
What are you telling your clients these days about where to go? Stocks, bonds, alternatives? I mean, the market's had a great year this year. Bonds have actually had a positive return. What are you telling them about these markets?
So the first thing is, I think when you're looking at what could drive markets, right now you could say the economy, you could say elections, you could say earnings, and geopolitics to a certain extent. I think there's a lot of people trying to trade around elections. Our advice is policy, not politics, is going to drive markets. So we are not making any significant portfolio changes on the back of that. I think there are, and I know a lot of people have been discussing this, there's always an excuse not to invest. There's always something to be worried about. But when you look at the tailwinds that we have right now, cash on the sidelines, $6.5 trillion. You have a Fed that, okay, whether it's another 25 basis points, 225 basis points, they are cutting rates. They're strengthening the consumer based on stock market prices, home prices. So I think there's actually a lot of positive tailwinds for risk assets.
Kristen Bitterly, with your experience at Citigroup, what's the level of exuberance right now? I am thunderstruck by the lack of taxi cab talk over what do I do with NVIDIA. I don't see, and there's some mathematics on this. Either. Yardeni and others have said, look, the exuberance just isn't there. When you go into a given institutional client to do wealth at work, are they foaming at the mouth to buy the Mag 7?
No, I think they're looking actually for much more balanced approaches to it.
I think will that balanced approach get it done?
So what I will say is it's better than not being invested. So
Fair.
The first step,
Fair.
Get invested, right? You could have a debate around passive versus active. It's first, being invested is better than not being invested. I think when it comes to the balance of conservative assets versus risk assets, you've seen a skew towards cash. With rates where they've been, massive skew towards cash. So that's another common conversation. Let's shift some of that risk profile.
David Balin was at Citigroup and he aged. David Balin aged because everybody stayed in cash. He said, Tom, I'm pulling my hair out. I mean, how do we get from where we are to optimism, to enthusiasm about owning a balanced SPX portfolio, even away from Microsoft?
I think you have to get away from the market timing conversation. You and I have talked about this, and it is something that market people believe. Just like I said, there's always a reason not to invest. There's always a reason that there could be a risk. It feels good to stay in cash on the sidelines. But look, if you stayed in cash on the sidelines year to date and you miss this 20% plus rally within equities, you are significantly underperforming. I think another thing that is actually a really positive, we talk about this all the time, longevity. People are living longer. Yep. The population over 80 is expected to triple. The population over 65 is expected to double. What does that mean in terms of how your money has to work for you? It has to work longer. So it's not just about risk assets, it's actually about, and your previous guest spoke about this, alternatives as well.
Yep.
You need those assets to work harder for you.
That's why I'm still working. How about you go to some of your associates at some of these law firms? I'm guessing they have a lot of debt that maybe we didn't have from education. That's got to make it tough on the younger folks.
I think it makes it tough on younger folks in all industries. And so you have to look at your balance sheet analysis. And I'm bringing this full circle to planning, looking at any type, looking at the interest rate on that debt. Not all debt is bad,
Yep,
right?
yep,
So,
yep.
I mean, if you were someone who locked in one of those 30-rate fixed mortgages, like
Right.
you won the lottery. So looking at debt not as necessarily bad in and of itself, but in terms of high rate, low rate, and trying to optimize your balance sheet, and then finding liquidity for where you can invest and where you can make those important investments for your family as well, such
Right.
as owning your home.
I mean, I got to look back here. Notre Dame beat Purdue 66-7.
They're good.
I thought it was a
Yeah.
fluke because
I know.
Purdue is a powerhouse
Yep.
this year. I don't think there's any other football team other than the Notre Dame's Kristen Bitterly that have won as big as they've won this year. They're ranked 12th in the country, but they're ginormous.
We
when
had
they
an
win.
unfortunate loss early on in our season, which was a little heartbreaking. But I'm an avid Notre Dame fan, and
Yeah.
I'm going to
Isn't
be an
everyone, though-
optimist here.
I've never met a Notre Dame fan who's
Northern
not an avid fan.
Illinois.
Yeah, Northern Illinois.
Northern
yeah, it
Illinois.
happened
They're
our
powerhouse,
second
Tom.
game,
They're
Tom.
powerhouse.
It was after beating Texas A&M.
So after that was shots of tequila, right?
Mezcal for me, but yes.
Okay.
Yes.
I mean, the work you're doing, this is God's work, folks. I mean, this is really serious stuff. Listen to Roger Ferguson, the former vice chairman, TIAA-CREF. I mean, I'm sorry. This is the most important interview of the day. The percentage of Americans cratering in retirement and financial planning is off the chart. Kristen Bitterly with Jane Fraser at Citigroup Wealth at Work. Kristen, thank you.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.